Joining us for an update on the international markets, particularly the financials, is Kokkie Kooyman, the Global Fund Manager at Sanlam Investments. Nice to have you in our Cape Town studio, Kokkie. It's not really good news we can talk about. I thought for a moment that the JSE was stabilizing. It certainly was in the initial stages, but selling waves came through here, selling waves internationally. The banks that you've been following very closely on Wall Street came out with pretty good financial results, yet the consequence was, well, you'd swear that they'd actually disappointed.
Yeah. No, I mean, if you just look at the results generally that have come through, specifically Citigroup, which beat expectations by quite far, and is trading at 25% discount to tangible net asset value. And yet, on the results, the price went up, and then the next 2 days it goes down 5 to 6%. JP Morgan also came out with actually quite good results, except for further litigation reserving, and the price goes down 10 to 12%. So I think what's quite clear here that this is simply a panic in the market. Investors that were overweight or weak holders are selling out. But it's actually good news. I mean, if you're going to be investing for the next few years and building up retirement savings, then this is a great opportunity to really pile in and invest more. And if you've got to think as well, the news flow coming out of Europe and Japan and even the US shows that interest rates aren't going to go up for a while. And so you're going to sit with 0.25%, 0.5% on your savings. And you're getting a lot of these banks on dividend yields of 4 or 5%. So it's a total overreaction by the market.
Overreaction. So clearly one should ignore the sentiment, judging by your comments there, Kokkie. Maybe when you look at the banks and their different strategies, does one need to be slightly more selective in their choices with regard to investment?
Yeah. No, I mean that is the key. And the market there is not silly. If you look at something like US Bancorp, and Wells Fargo, two of the best-run banks in the US, have come through the crisis exceptionally well. But they're trading on 2.5 times price to net asset value and higher. And something like Citigroup, which has had a very patchy track record, is trading at a 25% discount. So the market there is saying there are some banks that they are very happy with the management team and that will continue delivering value. And so, as an investor, you've always got the two decisions you've got to make. The one, do you just go for quality and pay up and sleep well at night? Or do you sometimes take a risk on something like Citigroup and say, the market is wrong here. At this discount, I think this is a good investment. And you've got the same in South Africa, where Capitec and First Rand are trading at very high multiples, and something like Standard Bank is actually being demolished relative to the other two. Now, if you go back 6 years, 2006, that's 8 years, Standard Bank was trading at a premium to First Rand. So, I think the discerning investor says Standard Bank should get back there. And so, it's maybe a better opportunity now to invest in Standard Bank. But in terms of your question, it always comes, do you go for quality now when the prices come down, or do you go for something that's a higher risk?
Kokkie, we do know that Berkshire Hathaway, Warren Buffett's company, has got a big option on those Bank of America shares. And if he's going to make an investment there at some point in future, who are we not to coattail him? Has that come, where would that fall in the good management pay up or the not such good management discount league?
Alec, as usual, you're too sharp here for me. No, that's a very good question. But what you must bear in mind that Warren Buffett bought into Bank of America, I think it was 2010 or 11, when the share price had fallen to $5, and he got it at $5, and he got it via warrants. And the share price of Bank of America is, it was over 17 last week. It's now fallen to, I think, 16.50. So, that was really shrewd. And that's a very good example where he said at $5, this is not a good quality company like Wells Fargo or US Bancorp, but at $5, it was just so cheap. And by the way, if you look at it, the fines that Bank of America has paid since he bought it is huge, yet the share price has tripled because all of that was in the price. So you've got to really decide, is the bad news in the price? And yeah, so I think you're getting some opportunities now, like with Warren, you're not getting them at, it was trading at 0.5 price to NAV, but Citigroup is trading at 0.75, you know, and Citigroup will be around. They've built up their reserves, they've built up their capital, they've written off the bad debt. So it's one of our top picks. Citigroup, and by the way, AIG is two of our top picks in our funds, in our global financial fund. It's more than 10% of the fund.
So to buy one banking share in America, it would be Citigroup.
Well, Alec, as you know, it's very dangerous to say one banking share, but if you have exposure and you want some more exposure, the thing you should have exposure to is Citigroup, and I think AIG as well.
From a South African connection, this morning on SENS, we had news that Old Mutual has now concluded its IPO placement for the Old Mutual Asset Management, which is listed in America. $14 a share is the price. Old Mutual itself is going to get about $450 million, which sounds like a pretty useful amount of money that's going to go into the London-listed company. Does this make it more appealing, particularly as that share price has come down a long way in the last couple of weeks?
Yeah, Old Mutual has actually been a poor performer for a while. I think it's must be UK investors who hold it, who sell it because of a negative view on South Africa, or whatever, investors taking a negative view on South Africa. But to put the $450 million into context, it's fairly small fry in the total scheme. And you know, Old Mutual have targeted acquisitions in Africa to the value of 5 billion rand, which is almost $450 million. So you know, they've spent, I think, about 20% of that. So yeah, this is more or less what they were planning to spend on Africa. So it helps, but it's not big. But I think what is interesting for Old Mutual is that, remember, they listed, I think, only 18% of Old Mutual asset managers US. So it gives an independent valuation, a market valuation to that, and that most probably is higher than what the market was putting on it inside Old Mutual. So, you know, it should add to the uplift of Old Mutual, and you get the staff there most probably more incentivized. So I think it was a good move, and Old Mutual is also now actually quite cheap in South Africa.